I'm super excited to be joined here today by Emad Hasan and Madan Bharadwaj. They are both co-founders of Retina and Measured, experts in their field. I'm also excited to show my incredible taste in art with my living room with everyone here today. Super excited for this. And we're going to have a very, very good conversation. It's going to be very dense at times, but don't worry, we're going to have plenty of time for Q&A. We want to get technical because this is obviously about the intersection of two really important topics at the vanguard of marketing science. And to start, I'm going to actually kick this off to the gentleman joining me today. I'd love to start, Emad, with yourself. I'm going to share my screen. And, this is always the moment of truth when we do the screen share. So bear with me. Can everyone see my screen?
Yeah, I think so.
Excellent. Oh, fantastic. Okay. So I'd like to start with operational definitions. It's the scientist in me. I always want to make sure we're all talking about the same thing before we go forward. And these are two terms that I hear probably 15 different definitions on when I walk in the world. Emad, let's start with you on customer lifetime value. If you could give me a little bit of a baseline in it and a little bit of your background leading to your passion with respect to it, I'd love that.
Yeah, thanks, Michael. Yeah, I'll quickly give you guys a background on what I've been up to. So at Retina, obviously, we've been very focused on customer lifetime value. But prior to this, my passion has been in customer analytics. I spent a couple of years at Facebook prior to this, running marketing operations there, where we dealt with ads and marketing science, looking at lift of different types of marketing activities. And prior to that, consumer data science at PayPal, doing customer segmentation, churn analysis, and building machine learning models that were used for merchant analytics. Today, what I'm really excited to kind of share with everyone is how we think about customer lifetime value and how that thinking has evolved. And I'm also really excited to join the conversation with Madan on how incrementality is now a really big aspect of thinking about businesses' success, and incrementality plus LTV is where that's going. To get started, customer lifetime value. What is customer lifetime value? So the academic definition of customer lifetime value is sum of your total profits over the course of a customer's lifetime. Typically, since it's looking into the future, you want to apply some sort of discount rates as well. But in this case, we're going to keep it simple. What is the full lifetime of a customer, and what is the exact amount of profits you're going to make during that time? That's what we're thinking about. And to get everybody on the same page, I wanted to share this illustration and quickly talk through this with everyone. And I'm not going to go into the churn probabilities, but at least quickly chat about what this looks like. So what you're looking at on the horizontal line is a typical customer journey from their first purchase to 5 years out from that time. And let's say today is about 3 years from that first purchase. So what we can observe historically is that this customer has had 6 purchases, totaling of $72. And over the course of the next 2 years, they still are going to be able to make a few more purchases. And that's the part that we have to predict. That's where the science comes in predicting what their future looks like.
Now, Emad, I have to say, this is just not to cut you off, but this is a really interesting point here, because a lot of what I hear in the market is, yes, I know the lifetime value of my customers, and that's either what they've spent, from when they came on board to date, so it's historical, or it's time. It's I have some way of predicting over the next maybe 6 months or a year. I noticed here you use a 5-year window. I'd love for you, as you're continuing to break this down, to also help me understand, how to think about that window, how to think about things like seasonality, because obviously this is something that's going to be a later on question that we'll be talking about. It's on everybody's mind, which is how do you predict what's coming with what you know now? But maybe you could help me break that down a bit more.
Yeah, exactly. And to break it down, you really have to think about like historical value and residual value or future value. Why did I pick 5-year window? That's just an illustration. If your business is one that like people buy every 4 years, then you might want to be looking at like 30, 40-year horizons, or even the full lifetime of a customer. So that window changes based on the type of business you are. And I'll talk a little bit about it when I talk about the different types of modeling that get done. But the most important thing for everyone to keep in mind today here is that a total customer lifetime value is typically a combination of historical value of the customer that you can measure, and some amount is a residual value that you have to predict. And combination of the two is what you typically look at. And now, does it matter? Can you look at it at individual level, or can you look at it at the aggregate level? And this illustration here's where I want to show that why individual level matters a lot. Take a look at the first two customers here. The first customer, 4 purchases. The second customer, 4 purchases, but they're done at a different intertransaction time or a different frequency. And if you looked at this, you can very easily grok that the first customer is likely not going to come back, and the second customer is likely going to keep coming back and has a higher lifetime value than the first customer. Now, Michael, you had a question around seasonality. This is exactly right. So let's say that this was less than a year timeline that we're looking at. You would say, yeah, this is correct. But what if you looked at this over 3 years and that first customer is only shopping every Christmas and keeps coming back? In that case, the LTV of the first customer might actually go higher than the second one. So that's how seasonality can come into play.
Yeah, this is interesting, and I'm sure we'll touch on it later, though I do want to kind of get into also the magic of incrementality. But before we do, that last part you mentioned on recency is a big one, and recency bias, and maybe a little bit later on we should touch on that, because that is a huge area where I see LTV making lifts here. But before we do, let's move on to incrementality. Madan, I'm going to throw it to you. Take us a little bit through ways to think about it.
Yeah. Thanks, Michael and Emad, for having us on the webinar. So the way we define incrementality or incremental conversions is mathematically we call it as last touch conversions minus baseline conversions, right? Say, for example, you went in, you pulled conversion reporting from Facebook's ads manager for a lookalike campaign you ran last month, and it said you drove 100 conversions, let's say, and that's what you're looking at on screen. If you go to the next slide, Michael, what we are able to say is that a bunch of those conversions, out of the 100, let's say 60 of those conversions would have happened anyway because of other influences. Let's say you are running search campaigns. Let's say you're running direct mail programs or TV programs, and there's maybe a seasonal behavior. And a bunch of those conversions would have happened anyway, and those conversions are what we call baseline conversions. And another set of conversions happened only because you ran advertising on Facebook. And those are what we call incremental conversions. So the last touch conversions, we decompose into 2 buckets, incremental and baseline. And that's the rudimentary example or definition of incrementality from our perspective.
That's super interesting. And obviously, you've dedicated a huge portion of your career to this. One of the things that you're answering is something that when I speak to marketers, it's the hard question to ask, which is, did what I just did make a difference? Or would it have really happened, right? And heretofore, that's kind of a question that we have to throw our hands up on. I'd love, as this conversation continues, for you to really touch on how we get confidence around that, how we get confidence around our marketing actions, having that impact, and how that goes into some waste optimization. But this kind of brings in how they come together. And this intersection of customer lifetime value and incrementality, which is sort of at the bleeding edge right now in marketing science. So Emad, to kind of throw this back, or actually I think Madan, I'd like you to talk a little bit more on the channel side, and then Emad layer this on. Could you talk to me about it from a channel perspective?
Yeah, absolutely. So one of the biggest things marketers trip up on is that, incrementality is not one flat number across the entire tactics, a portfolio of tactics you are invested in. For example, let's say you went in and you pulled reporting from Facebook and from AdWords and your matchback reporting from catalog. You broke them up into proper tactics, into retargeting and prospecting. Let's say it looks like this. Now, if you went in and ran incrementality tests for each one of those tactics, what you might end up finding out is that incrementality on retargeting is much lower than incrementality on Facebook prospecting. Incrementality on branded search is much lower than non-branded search, and so on and so forth. In general, what we find is that if you think of the marketing funnel, lower funnel tactics have a lower incrementality because they have a higher baseline expectation, and upper funnel tactics have higher incrementality because they have a lower baseline expectation, right? So this is one of the biggest things you trip upon. And the most important thing behind that is when you make investment decisions based on last touch ROI metrics like ROAS and CPA, what you end up finding out is that it is suboptimally allocated, and most marketing portfolios have 20 to 30% optimization efficiency just by reallocating based on incremental ROI metrics, incremental CPA and incremental ROAS.
And Madan, is that because as you go down the funnel, you've already basically had a chance to do your brand marketing and programmatic, you've already driven some intent, and so intent is sort of increasing in, almost non-linear fashion as we get closer to purchase?
You got it. Exactly right. A prototypical example is retargeting. Somebody came to your site, spent time on your site. So they've qualified themselves as having intent, right? And then you go and retarget them in the open web and you bring them back. But they had a baseline intent to begin with because they came.
Yeah.
That's right. And that's measuring that makes a huge difference. And one of the sort of archetypal sort of optimization opportunities, prospecting versus retargeting. So when you look at last touch CPAs, it looks like retargeting is killing it. Prospecting is really like burning money for you. But when you apply incrementality coefficients to it, the numbers change and the investment decision actually flips for most marketers. And you end up making a data-driven case to invest more in prospecting and less in retargeting because of incrementality.
Got it. Okay, that's interesting. So I guess, mentioning ROAS and mentioning measurement, LTV historically has not been in that game. And, the reasons for that have been it's historically taken a long time to truly get an accurate resolution on it. That's changed recently. And so now LTV is something that I know, Madan, many of your customers are speaking about and wanting to join with this. But Emad, I'd like you to kind of talk to me about why you think it's at least becoming one of the chief metrics and how we should be shifting from ROAS.
Yeah, thanks, Michael. Yeah, so basically I got to see this firsthand at Facebook. So as we were looking at advertisers marketing on digital channels, what's happening is as advertising dollars are pouring into these closed wall digital channels, a lot of the pricing is going up such that your customer acquisition cost is no longer ROI positive on your first transaction. And as a result, businesses are having to look at this equation differently. And they're also realizing that once you acquire a customer, there's generally not a lot that has to be done for them to keep coming back as long as the product itself is good and there's a retention built in. So now looking at ROAS not as a metric of first conversion, but switching it to a lifetime value of how much value you expect to get out of a customer is becoming a lot more important. And this is shifting conversions in the growth teams across the advertising industry, where you're not only looking at, hey, what's my conversion rate, but what's my lifetime value? And here's a really good example of layering. Once you have that individual customer lifetime value calculated, you can then start to look at what your average LTV by different channels are. And here you can kind of see we've layered different channels. And if you look at the lifetime value of the different channels, they vary quite a bit coming from different channels. So for example, somebody coming in from Google, row 8 here, is like 10% higher lifetime value than the rest of the general population, versus in this case, 3% higher when you're coming in through Facebook, showing that intent of like wanting that product is much more useful. But more importantly, this brings us back to that conversation of incrementality.
Right. As soon as you said intent, and I was thinking about the funnel and last touch, I was thinking about what we were just warned about with Madan, which was around this idea of be very careful about last touch. It can kind of be a siren song and lead you to a lot of waste. So Madan, maybe you can help us bring this together right here.
Yeah, I'll say two things. One is that just like how we're able to decompose revenue into baseline and incremental, we're able to do the exact same thing for LTV as well. We're able to take channel level LTV estimates and then also break them up into baseline and incremental. And you can see that it looks very different when you actually break them up. But if you go to the next slide, Michael, what's more relevant here is that if you kind of paid attention to Emad's slide there, LTV is not evenly distributed across channels. Some channels are bring in more higher value customers than others. And when you marry that with the investment you're making on those channels, what you might find here is that the ROAS curve, and if you look at PPC non-brand as an example, it's strong, but it's not the strongest ROI driver for in that particular sub-portfolio. But if you look at the LTV per dollar, which is the ROI metric on LTV, it is the most valuable channel in your portfolio in terms of bringing in high-value customers, right? So the actual investment decision will actually change if you plan based on LTV metrics as opposed to ROAS metrics. And this has been essentially, as Michael keeps bringing us back, the cutting edge of decision science in marketing. Having good LTV estimates and marrying it with incrementality in channel-based data allows you to make much higher quality decisions and get much more bang for the buck for your investments.
Absolutely. And just to kind of take this up a level, one thing tactically I see oftentimes in the market is not just that biasing towards last touch, but I've seen also very sophisticated marketers, because you have to develop proxy signals for a high value customer when you don't yet know how to measure it from LTV. They'll use things like average order value, right? Or first purchase value. And that's where you can also have some of these things where you think your ROAS was great, but if you have customers that come back multiple times, it might be actually that's not the case, that these are customers that might actually return quite a bit, or they are one and dones. And so being able to actually move beyond just that window of the first purchase and really see that downstream value coupled with understanding incrementality, it sounds like that's where waste optimization on your spend can really happen. However, that brings us to the big question of, what can we do? Can we get this at the customer level? How early in the customer journey? Oftentimes these are averages at the cohort level, which brings me to what's the state of the art. So Emad, I'm going to throw that to you. Let's talk about it. And for those at home, if you haven't had your coffee, I would get it, because we're about to get into machine learning. This is one of my favorite things to dive into. So Emad, I'll let you take this one away.
Yeah. So we've chatted about a few things. You need to be able to do incrementality measurement on LTV. You need a few things. You need individual level customer lifetime value. You want it early because you're spending media dollars today, not 6 months from now. And you want it to be interpretable to whatever extent you can explain what's going on in the model. Now, let me tell you about what are the different methodologies we are seeing out there that companies tend to use. The most basic one is a cohort retention-based LTV model, where you look at your active customers and how they're slowly churning for each cohort you've acquired. There's nothing like data sciencey going on. It's purely an analytical exercise. But it's very useful because you can quickly see which cohorts are churning fast, which cohorts are not churning fast. It's not early. You have to wait around. You have to wait to see how quickly that survival curve is going down. But it's accurate at the aggregate level and can do the job if you're willing to wait. ML-based models are the other ones we get to see. So video gaming companies tend to use this, like mobile games that have in-app purchases, where you might have a period of like trial where you're making where you're not monetizing the app. These ones are short horizon windows. There are a lot of features that you can use to like try to correlate with customer lifetime value. So this is where like machine learning models that are based on like random forest or XGBoost get used. They're very accurate at the individual customer level in a sense that they can give you a good idea of if that customer will monetize or not, and to what extent within like a three month to a 1 year window. Lots of video gaming companies use.
I noticed that you have this word interpretable there, which is something I hear a lot, which is, sometimes you have to sacrifice accuracy for interpretation or vice versa.
Right.
With respect to that one, it sounds like for businesses with high transaction frequency like gaming, you can get this accuracy. What do you mean by it's not interpretable?
Right. So typically these models tend to be neural network-based models more often than not. And the neural network models are by design black box models that input in, outputs, and it will get you the answer, but how it got to the answer is not always clear. However, if they've built like a random decision tree based model, there's some interpretability there. But typically the ones we get to see, especially in video gaming, are non-interpretable models.
Kind of spits out an answer is what you're telling me.
Exactly
I have no idea why or what. makes it that. Okay, all right. Buy till you die. That one sounds ominous. What
Buy till you die is actually one of the most well-studied academic model. University of Pennsylvania already academics of these models for quite a long time, and what these models are using are recency, buying, purchase, inter-transaction times, and modeling out the curves on how much spend is happening. These are really the latest and greatest on open source models that we're seeing out there. They can do long-term predictions for 10 years, 15 years, and they can simulate all of that out. They're generally fairly accurate at the individual level, but very accurate at the aggregate level, to a point where Dan McCarthy's team is now using these for corporate valuations. Really good stuff here. And then there is the part that these are less competent on are getting to customer lifetime value early, because they're purely relying on that transactional behavior, and the covariates tend to help, but not as much. We've seen many companies try this, and getting to accurate LTV early is very, very difficult for these buy till you die models. That's where we've kind of pushed that cutting edge. We use these algorithms called generative neural networks and GLRM that can address that concern, because we want media buyers who are spending media dollars today to be making decisions around LTV incrementality today, and trying to do that with a high amount of accuracy.
So this is great. And I know we're already getting some questions, which we'll get to in a later section, about the kind of data you need and what to handle when you have, major discontinuities like shift with COVID. So I definitely will put a pin in that, but this is fantastic. And obviously during Q&A, happy to drill down on the kinds of businesses or data prerequisites for that. That being said, I kind of want to go through the exact same journey with how we got to incrementality. So Madan, I'm going to pass this to you here. Maybe you can take us.
Yeah, so happy to. I'm going to sort of walk you through sort of a historical perspective, also a list of approaches that are current with respect to marketing measurement. So I want to start with the tried and tested approach. It's called marketing mix models. It's been around for forever. Originally sort of innovated around the CPG space and Coke and the P&G brands for modeling transactions for CPG brands. It uses a statistical empirical approach to build models, and it's really good and has good explanatory power, good at modeling macro factors like, competition, government regulation, pricing, and overall investment in media, and is really good at giving you strong macro insights, not as strong as the tactical insights like audience and campaign and ad sets and whatnot. So a lot of times people are using it for understanding directional macro strategy, so to speak. And in 2008, 2010 timeframe, we hit one more multi-touch attribution came to be. This approach essentially is built on collecting user-level data using third-party pixels, building customer journeys based on cookie IDs, and using ML algorithms to decompose the fractional credit for every touch along the path, and so on and so forth. It's really granular, great granular, gives you insight into customer journeys, which was thought of at one point to be sort of a breakthrough idea. In the more last 5-7 years, what's happened is that the rise of Facebook and the walled gardens and privacy regulations has really sort of outlawed a lot of this collection of user level data. So this approach has narrowed in terms of its ability to measure media for a large part. The latest and greatest with respect to media measurement is really incrementality, which today mostly is anchored on experimentation. So it's all about designing appropriate experiments. We call them DOVs, design of experiments, that is tailored around how audiences are activated on Facebook versus search versus direct mail versus TV, and really deploying those experiments to understand the impact of media in driving whatever outcomes, sales or conversions or subscriptions or whatever you care about. The great thing about that is that it's very ubiquitous. You can design experiments for practically anything, any media channel. It's reliable, transparent, defensible. It's very granular insights now, the way the place where the technology is. The limitations are you can run 1 or 2 tests by hand, but if you want to have a measurement program in place, does require a lot of automation and technology, and also requires a lot of customization for each one of these channels. Now, Facebook looks very different than search and very different than catalog, and therefore having to design these experiments in ways they understand these nuances and how audiences are represented and activated makes a huge difference. So there's some complexity there, but this is the latest and greatest with respect to measurement.
You know, this is interesting, and obviously I'm not going to put Emad in the hot seat here because he happened to work for Facebook, but I do know that it's difficult to trust the numbers that you get reported out of their own platforms. And as we're seeing this sort of omni-channel collapse, especially during COVID, into e-commerce, so more and more spend will be shifting into these walled gardens. You know, this seems to be more and more important. You mentioned, though, this need to build that muscle on your team, where you have to learn about experimental design. Obviously, you want to start piloting with one or two, but if you want to start scaling that out, you're going to need to build some technical apparatus or work with a partner. What are the ways in which you recommend people start even bringing that up or thinking about that with their leadership? Because I know that marketers are always at the bleeding edge of this, as well as the people that are in BI. They kind of have a scientist spirit, but how should they be thinking about the need for raising this as a priority to leadership?
Yeah, I think what we've found most success is that there is a sort of a delicate balance between the CFO and the CMO, right? Marketing and finance always sort of like, there's a tug of war on how to represent efficacy or the contribution of marketing to business. And I think measurement sits right in the middle. What we find is that when we have the conversation with both the finance stakeholder and the marketing stakeholders, when this conversation really takes root, because it is one currency, one language to talk to both stakeholders. Marketers can understand incrementality and represent the contribution to business in incremental terms, and their investment on Facebook and search and TV all can be represented in ways in KPIs that finance can understand. And finance can take off of that and say, well, this is how I understand your contribution, so I can understand how to invest into marketing. So the best conversations we have, the most traction we have, is when those two stakeholders, in either in a CMO level or a director or a VP level, is when we end up having the most meaningful conversations.
Got it. And Emad, with respect to the CFOs, because I know you work with a lot of them, and they're starting to do a big shift towards making LTV a key metric across the enterprise. Maybe you could talk to me a little bit about what you're seeing on that front and how that's changing the relationship with marketing.
Yeah, I think the biggest change we are seeing is this focus on profitability. We know that, you know, over the course of the last 3 years, a lot of businesses were focused on growth, purely on growth, and that has started to shift quite a bit. And honestly, even pre-COVID, we were seeing some of that, and that's just accelerated quite a bit at this point. Almost every advertiser we've worked with, every brand we've worked with, we are seeing media dollars being cut without really much thought on like what is being cut. Like a lot of that is happening. So given the COVID scenario, I think a lot of things are changing that are very different from what we were seeing in change pre-COVID. But yeah, we can talk a little bit about that as well.
Yeah, absolutely. You know, and just on my 2 cents on this, as someone who's both run businesses that have been acquired by private equity, which obviously is razor focused on profitable unit economics, to working in venture capital, where the old joke was lose money on every customer and make up for it at scale. I think the whole world has now shifted to we have to scale profitably. Otherwise, you know, we're not going to be a going concern. So I appreciate that forcing mechanism, which brings me to COVID. Now, obviously, every day we are getting new information, and you know, actioning in this time of indecision is difficult. And everything we've discussed heretofore is to help you get insight into what's working and what's not. I would love to throw it to you, Madan, first on what you're seeing in market, maybe even some things that are counterintuitive that you can share. And then we'll go from there.
Yeah, absolutely. I do want to, so we look at this data all the time. We're constantly studying patterns in markets. I really want to focus on fashion brands, a category of brand, fashion, which is a significant category in our portfolio. Which is not, I just want to fashion is not like essentials like grocery or or even health and wellness, which is taken off here. Fashion's really getting hit hard. So the story out there in market is that it's bleeding. Retail exposure is really made everybody bleed quite heavily, and that's true. But the picture is a little more nuanced, and I just want to sort of speak to that. So if you look at this picture, this is the change in spend compared to February. What the percentage change in spend compared to February for all fashion brands in our portfolio. When we look at it, a majority of the brands were in the blue line cohort, which is they pulled back marketing spend. So a lot of them reacted to COVID by pulling back spend, and they kept spend low compared to February, which was a de facto response. Most of the marketers fell in there, but not all of them. A smaller cohort of marketers kept their spend steady through the crisis. If you look at the stay the course cohort, they kind of dropped for 1 week there, but they kind of kept steady for the rest of the weeks. And another cohort of marketers were fighting for their lives. They were like, they reacted to the loss in demand with aggressive promotions, and in many cases, media spend backing those promos. So very different responses to the crisis from marketers in our portfolio. Now, if you go to the next slide, now if you look at the results that they're seeing in market, this is revenue, change in revenue compared to February 2020, and also compared to March and equivalent comp weeks back in 2019. What we're finding is that the fight back cohort, the make something happen cohort of marketers who fought back with aggressive promos, are having explosive growth in market. Now you can see that they grew through the crisis in March, and then what's happened is that as you kind of look at early April results, what we're finding is that they are now seeing results that are rivaling holiday and Black Friday results. And many of them have made up for the loss in retail revenue in e-com revenue alone. So they're exploding. You can see the 300% growth compared to both last year and February. They're taking off.
So
now, if you look at the state.
Yeah. So sorry, just to interject really briefly on this. This is speaking to the fact that there was still pent-up demand as we had all of this shift off of retail offline into online. And that these brands, even in the non-essential space, those that went after market, were seeing outsized returns. What happened with this group, though? It looks like that kind of did a pullback. It seemed like they had moderate or something of a downturn. Could you kind of unpack that for me?
That's right. So the stay the course cohort kind of stayed steady. They had decent, modest growth. And if you look at compared to last year, they were still up 33%, right? But it's modest growth because they kept spend in market. And the cohort of marketers who pulled money out of market aggressively, and with all empathy, because they're furloughing employees and there's bloodbath all around. So spending in marketing may seem pretty sort of tone deaf to what's happening elsewhere in the enterprise. But if you look at what happened to them is they've had the most bloodbath, 33-40% down the middle of March. They're coming back up. They're still down 33% compared to last year. And this is just e-com. Doesn't count for retail, of course. Retail's completely shut down. And fully empathic, you have two sales channels. Retail's completely shut down. And these marketers now have an existential crisis. They can either have one sick channel or two sick channels if they don't invest. So they're between a rock and a hard place. But the key takeaway here I want to leave people with is that e-com demand is healthy. We're finding everywhere, not just in these metrics, but site metrics and conversion rates and time spent on site, e-com demand is healthy. You can market into it. And now folks have to really now figure out how they're going to position e-com versus retail. Do they accelerate the digital transformation they've been talking about forever? These are strategic decisions that they're making in the time of shifting sands across the board.
Yeah, this is interesting because obviously if you don't yet have the muscle in place to then measure the impact and really see the results of what you're doing, it sounds like you're going to, by definition, have analysis paralysis because you're going to be spending without knowing how to track the efficacy of your spend. So, for those who haven't kind of completed this digital transformation, of which these two components we talked about today is critical, you probably have to do it as if it was yesterday. One of the things, though, and this is not to sound self-promoting, one of the things that's intriguing to me about this is as we spend more time at home, there seems to be a lot more mind share. And people are still using and shopping for non-essentials, maybe even more so than ever due to this increasing mind share. How long that will persist, obviously we're monitoring the situation, but the fact that you picked one of the most non-essential categories and we're still seeing this correlation with spend is fascinating to me. Emad, you know, I'd love to hear you weigh in on this, especially because you've seen it both inside the shop at PayPal and Facebook, and then today, you know, from your vantage point from LTV.
Yeah, I mean, and for us, like what we've been seeing is that there is a category of essentials and at-home stuff that people are buying and consuming that is seeing a surge in demand. And obviously the non-essential is like trying to keep up with this. And what Madan said is companies that are taking an offensive approach are seeing some gains, because what's happening is that now product is not the only thing people are buying, they're basing their buying decisions on. They're also looking at how fast things are shipping. Where is there supply that can get me stuff while I'm sitting at home? I'd rather get 1 day shipping versus like the 10-day shipping that Amazon's doing these days. So there's quite a bit of that happening. The other thing you're seeing is companies getting high loyalty customers through that like service and, for example, offline behavior. So any essential businesses that you were previously only buying online, but you are like walking over to the grocery store now, or like going over to a coffee shop or a smoothie store that's open, they're getting high LTV customers because they're treating those employees as heroes. They're like, I'm building brand affinity here. So we're seeing a lot of this like shift going on in how companies are acquiring high LTV customers, and companies taking a thoughtful offensive approach are seemingly doing well.
Well, this is great. And I have to say, you know, there are quite a few questions, and I wanted to make sure we had ample time to visit them. Some of them, by the way, and I'm happy to say, are very nuanced. Let me start kind of top down, and I want to go into a really good question around refreshing your testing, your incrementality testing. So how often you should be maybe refreshing your DOE or refreshing even what it is you're feeding through. Madan, would you be willing to tackle that?
Yeah, absolutely. I think we have a couple of different flavors of testing. We have something called always on tests. So always running tests in the background. That's, you know, many channels it's possible to do. We definitely, whenever it's possible, we do that. In other cases like branded search, for example, you can run a test, learn about the incrementality, but the incrementality doesn't change for branded search in a big way. And the decisions you would make also don't change. It's either a fund or not fund. You cannot really scale branded search, for example, right? So those are really one-time studies, and we may do it, you know, 3-4 times a year, maybe a couple of times a year if you're not it's not that an important decision for you to make. So there are two flavors. One is an always-on experiment that's always running, and others are sort of point-in-time studies. And it's really the whole measurement program is tailored around what decisions you are making and how measurement is feeding or informing those decisions, and that's kind of what drives the investment agenda.
Got it. So it's if I could re-encapsulate that, it's a function of the frequency of your decision making. If you're decisioning in a rapid rate, always on is probably what you'd bias to. If not,
That's
you
right.
can go and, okay, understood. Which now flows to the next question. And this actually is something, Madan, we've had some great chats with Emad and the background around, which is LTV being fed in as a measurement metric. And when a company brings their own LTV in, how it can be dangerous if it's, you know, either inaccurate or really not LTV, it's just historic numbers. Emad, would you like to talk a little bit about sort of what LTV you should be using in this testing in terms of measurement, and then sort of the pros and cons of how you feed in what you feed in from an LTV perspective?
Yeah, and I'd like to tag team on this question with Madan, because what I'll share is like at the individual customer level, you can measure LTV at the point of conversion and then keep measuring it as you get new information about the customer, right? This is what we would want to we typically want to feed into your incrementality measurement. Now, how do you go from that individual customer lifetime value at the customer level to measuring incrementality? Maybe Madan, you can weigh in on that.
Yeah, so we take in, typically what happens is we take in an incrementality feed from vendors like Retina, and it can come in a couple of different formats, either at the customer level or at the channel plus some sort of a week or a month level allows us to roll up these channel cohorts. And then we then marry the LTV feeds with media measurement feeds and report back all the media in incremental terms against an LTV and LTV per dollar metric, or whatever the ROI metric is relevant to you.
Excellent, excellent. So one question that comes down to accuracy then from LTV standpoint at the customer level versus cohort level, Emad, is at the customer level or cohort level, where would you see higher error rates and how exactly does that work?
Yeah, so when you first get a transaction or even pre-transaction, you might get a based purely on the types of attributes you know about that, how they belong to one type of buying behavior or the other. As you get more transactions, your accuracy can only go up from there. And that typically tends to be the transactions-based LTV. And generally, we've seen the error rate below 20% going to like sub 5% over time.
Got it. So, and I'm sorry, it was a little bit choppy. So would you re-encapsulate that one more time for us, Emad?
Yeah, so starting off, you might have like around like 20% individual error rate that might go all the way down to like 5% as you get further transactional behaviors coming in, where you're seeing seasonal or transactions coming in, and then over seasonality that will get even more accurate. But one thing that I think I can also answer is another question somebody had asked around was, how do you kind of like take into account data discontinuities such as COVID or some other. So there are three ways you want to look at time. One is absolute time, which is your calendar date. The other is relative time, which is relative to a customer's first purchase date, and that's like typically the cohort date. And then you also want to look at seasonal time. A model that can account for all three of those is probably the most useful model you can bring into your LTV modeling. The one that's the simplest one is relative time. Most people use because that's customers' first join date based on cohort, what cohort they came in on. And the second thing you want to bring in is seasonality. Seasonality is typically not modeled by most models out of the box. You have to build out covariates, and then feed that into the model. And then absolute time is rarely used, and that's where we use time series clustering, which enables us to kind of cluster all the three dimensions of time and figure out if something is going on today and we are seeing a certain subset of customers seeing an increase in demand and others seeing a decrease in demand, that can be modeled out very quickly. So you want to be able to account for all those three dimensions of time.
So that almost allows you to start measuring these deltas and change in behavior and seeing the outputs change relatively quickly. So you get a little more sensitivity there with respect to these discontinuities that were mentioned. Okay. Yeah. So this brings up, I'm going to do one more question for you, Emad, and then I'm throwing it to you, Madan, which is, it's a two-part question. One is, can you go into the benefits around this new GLRM or GNN models as opposed to machine learning and buy-to-die models? And how is it a departure from sort of that work that Peter Fader did and Dan McCarthy did, more than just even early purchasing, though that's obviously a big component?
Yeah, so as I was saying, like there are pros and cons of each of the models, and the biggest like value of the models that we look at is, can you predict at the individual customer level accurately? Can you predict it early on? And can it account for all of the data, like account for missing data? Can it account for seasonality and those things? The one place that we feel like GLRM is the one that has helped us quite a bit is it's getting to that individual customer lifetime value early on, so that it can be really useful in media buying decisions. Because the problem is, if you have to wait around for 3 or 4 transactions to see what buying frequency somebody has, then you are already fairly late, because most companies that we tend to see, like the buying is happening at a monthly level, or it's like every 2-3 months. So depending on that inter-transaction time, their decisioning can be fairly late.
Got it. And I know you mentioned also that buy till you die really is a function of transactional records, and it can accommodate covariates, but not well. Sounds like there's a lot more covariate accommodation, thus maybe more understanding on the drivers around lifetime value with those other classes. Is that a fair assumption?
That's a fair assumption. And having said that, look, we use buy till you die models quite a bit because they're really accurate for a lot of use cases, such as looking at historical, doing financial reporting, looking at historical value of the customers, doing groupings afterwards. For different use cases, there's still quite a few applications for
It can be good once you've had a decent period of time of
That's
observation
exactly right.
and you're really biasing to accuracy, not necessarily to others.
Yeah, and we typically recommend 18 months minimum of data that you
Which now, I think there's another question around AI versus humans in the loop for you, Madan, on designing of experiments. So could you kind of take us into what part of experimental design is, platform-based or AI, and what's human-based?
So the majority of the thinking intellectual capital that goes into experimentation is applying design of experiment principles to the specific channels and the nuances of those channels, right? So for example, what is an audience in Facebook? How do you activate it? How do you make sure that you select a control audience without introducing bias in the selection? How do you flight campaigns in ways that doesn't create bias? How do you measure that? How do you roll up data? The whole process of experimentation, data collection, roll up and statistical significance calculations, and how do you roll up statistic and do meta-analysis? Those are the kind of things that go into design of experiments, right? There is a role for AI in match market testing. So we do some of these places we have to do geo match market testing, and we do what's called match market models, where we have to build a model for Connecticut as a function of markets like Texas and California and whatnot, right? So we have to predict what Connecticut might do given what we're observing in other markets, for example. And there we have to build pretty sophisticated models around predicting one market as a function of the other. And there's a fair amount of ML that's involved in market selection and market prediction and all that stuff. But a lot of the work that we do is designing experiments for various vehicles and channels, understanding the nooks and crannies of these, and designing it in ways that are tactical and granular and aligned to decisions people are making on those channels.
Okay, that's really interesting. And kind of staying on that, there's a question around inflation rates, which is obviously similar to how we think about even discount rates too, and how that affects baseline and incrementality. Do you factor in things like inflation rate when thinking these experimental designs? I know it's something that we sometimes can consider in CLP.
Yeah, so what in many cases what we do is like there is an idea is that you want to run an experiment. You basically have a test cell where you're running actual campaigns. You have a control cell where you are observing those audiences in some way, either running PSAs or just observing those audiences and collecting their conversion information and then comparing it to the actual treated audience, right? That's the fundamental idea. Now, when we do it, we're trying to make sure everything else is controlled for, minus just the media exposure, right? That includes so that the exposed audience and the controlled audience are experiencing the world in exactly similar ways, including inflation rate, including whatever else. And then we can measure the incrementality on either a conversion basis or a revenue basis or an LTV basis and whatnot. And that's kind of where you can say, hey, you know what? Maybe the conversion lift is 22%, but the revenue lift is 27%, and the LTV lift is even more, maybe like 31%, depending on what the channel is, right? So we can get different cuts of incrementality, but fundamentally the approach is to control the variables in such a way that you don't have a bias in treatments.
No, that's okay. That's super helpful. And, it's interesting and I love that the audience right now is getting extremely technical. And so, Emad, I'm going to throw you one that I know I hear all the time. And I think it's a fair question. And it's something that Madan presaged when he mentioned the fashion vertical. So it's this idea of these volatile, non-subscription kinds of verticals like fashion versus subscription businesses. And how should we think about the metrics that we should be doing or how we should be tweaking LTV windows when you're dealing with highly erratic purchasing cycles like in fashion versus more normalized cycles like you see in subscription businesses? How should we think about tweaking those churn predictors and windows?
Yeah, really good question. I think this is one that the buy till you die models actually address head on using a framework, which is looking at continuous versus discrete businesses and putting that in a quadrant with subscription versus non-subscription business. So think about Amazon. It is a continuous non-subscription, they have a subscription service, but non-subscription type business where you are buying at whatever time you want and you're buying at different volumes. Like you might be buying something that might be worth $300 and another time buying something that's $3.
Like toilet paper. Got it.
Right, exactly. That's a very different business than, let's say, a Netflix business where everything is fixed. You're paying a fixed amount on a fixed date each month. And different models tend to work differently, do well in those different scenarios. So picking the right model. So the one that we were just talking about, the Amazon style business, the shifted beta geometric model gets used quite often. Now there are generic models that tend to do well. There are a lot of great papers out there for this. I see that we have Professor Bodapati who had joined. He had shared a few really good papers with me on this like general lifetime value models that can take into account any distribution of repeat purchase behavior and churn behavior and can then accommodate for that. It just might require you to build a more custom version of your algorithm.
Got it. By the way, so Professor Bodapati's on. I'm glad I didn't know that beforehand. I would be extremely nervous. Thank you, Professor. I hope I passed today. So, you know, I think what I'd like to do is we have about 5 minutes left, and I want to let everyone know if I didn't get to your questions or I tried to subsume your question into other questions, I want to give people, you know, I want to give our two participants a last word. But Emad, I saw you raise your hand. Did you want to?
I wanted to share one, somebody
Sure.
had asked a question on discount rates, and I wanted to quickly share my thoughts on that.
Sure.
Discount rates are fairly easy. If you can see my screen, you can take your annual discount rate, turn it into a daily discount rate, and then apply a discount factor, which is basically 1/1 plus your discount rate raised to the whatever time variable you have, if you're doing it daily, weekly. And I can share a quick this slide with you guys if you wanted to, but discount rates and inflation rates can be applied very simply in our models.
And what I was going to mention is that we will be sharing all of the slide material, including certain slides you didn't see that are in the appendices. And, you know, you can reach out to all of us directly for specific questions afterwards. You know, we'll make sure that information is given to you. But let me give you both a quick last word. It's been an absolute pleasure to host this. And maybe Madan, if you'd like to go first, and then Emad, I'll let you close it out.
Yeah, so I'll probably leave it with one COVID takeaway that we see all the time. I know a lot of marketers put in spend cuts in market in the March timeframe. When we looked at those spend cuts, it was executed in a rush in the middle of furloughs and spend cuts across the enterprise. A lot of the spend cuts were just put in inefficiently. Like all spend was cut 50%. Whereas if you look at media, some performs really well, some doesn't perform as well. So you should probably do a graduated cut. So that was not necessarily done across a lot of brands. So the one thing you can go back and do right now is look at your spend allocation in market right now and reallocate it in a more optimal way and get, you know, better efficiencies for the spend in market. So.
Thank you. No, that's definitely critical during this time. Emad, would you like to leave us with a final thought?
Yeah, I mean, look, we at Retina are extremely excited by the nerdiest questions about LTV. So please reach out. We are always happy to help have a discussion and help out where we can. We love helping practitioners as well as folks who are just getting their hands dirty now. And we think about customer lifetime value at a very early stage of a customer's journey, because one thing that like our partnership with Google and Facebook has shown is the best way of retaining or increasing customers' lifetime value is getting a high LTV customer to begin with. So we think about this problem a lot, and we're excited to continue the conversation with everybody.
Yeah, and just to end cap this, it's been a pleasure to frankly learn from you both, be a part of this journey, and really to see two practitioners that are trying to figure out what customers are doing as early as possible so that we can provide them the best possible experience. So thank you everyone for taking a little bit of time out of your day. I hope you have a wonderful and safe going into early summer. And if you have any questions, please send them our way. Appreciate it.
Thank you.
Everyone, take care. Bye.